Never again under 10K. For cereal this time. Let's go to chart school. In order to confirm a descending triangle pattern, you must demand at least 2 occasions where the bottom line, the horizontal support, has been tested, of which we have at least 3 or so. And then at least 2 occasions of it hitting this upper descending trend line, of which some contention arises. How do you draw that line? Do you count the wicks? I do on this occasion, but I can understand some people that don't. The average duration of such a pattern is 1 to 3 months before a resolution occurs. So far, it has been 86 days, or 2 months and 25 days. Interesting. Is it facetious of me to say that about my own analysis? It's an interesting question. Anywho, volume usually contracts during such an event, which we can see by drawing the same pattern. There's absolutely no point in drawing this horizontal one. It's a bit embarrassing. Overall, the trend is a bearish one until a break. So now for the moment you're all here for, what happens next? Shh, quiet please. I want to give you statistical percentages or what the chances are of a breakup or breakdown. Sadly, it's a little bit too complicated a matter for that. The duration of the pattern, whether it's a bear or bull market, the amount of times the support has been tested, all these things matter when analyzing a chart pattern and make it more complicated. But simply put, more often than not, price breaks down on the lower end. This horizontal line, which was once support, flipping into new resistance should a breakdown occur. Very sad to see. However, having said all of that, this is not the only way of charting Bitcoin right now, not at all. This version, I would say, is the second most popular interpretation of what is happening on Bitcoin right now that has slightly less of a bearish bias. What is drawn here cuts nothing off, is slightly extended, and shows perhaps a more symmetrical in shape triangle. Notoriously difficult to predict. Rallies are sold off, yet simultaneously the dips are greeted increasingly as buying opportunities. In other words, supply and demand is in equilibrium, but cannot be for long. Eventually, either the bulls or the bears will overrun each other. What both charts have in common is the tendency to resolve explosively, marked by heavy volume. The Encyclopedia of Chart Patterns, as I just so happen to have here, references that for descending triangles at least, an amazing 40% of the patterns in a bull market with upward breakout show rises over 45%. That percentage is huge. Notice how numbers from the downward breakout side of the street pale by comparison. Less than 10% of the triangles decline more than 45%. That would be great. If that were to happen to Bitcoin right now, that would mean Bitcoin would peak very briefly at 14,500 before no doubt pulling backwards. Once price reaches the ultimate higher low, what happens? For upward breakouts, prices tumble about 32% on average. For downward breakouts, the rise is about 55%. All in all, this is good for Bitcoin. Class dismissed. Speaking of things potentially good for Bitcoin, are the Fed going crazy? After the stress in the markets, which saw interest rates get as high as 5 times what they should be in the overnight lending market, the Fed have plans to do another $75 billion overnight repo operation on Friday. It follows liquidity doses of the same size Thursday and Wednesday and $53 billion on Tuesday. How much is this? 75 today, same size on Thursday and Wednesday, and 53 on Tuesday. $278 billion printed this week. All that to keep the lid on an already boiling kettle. They printed not just more than the entire market cap of Bitcoin, but the entire market cap of crypto in a single week. Crazy and downright reckless. But to be fair, this is a loan. The banks have to pay that money back to the Fed likely the very next day, so this isn't new money hitting the economy, technically speaking. The central bank is deploying this remedy for the first time in a decade. So the major point of interest in this story is not actually the devaluing of the dollar, not yet at least. The major interesting point is, why is dollar funding becoming scarce? This was practically a bank run, orchestrated by the banks themselves. In case you're not aware, when you give money to the bank, they don't actually keep all of it safe for you. If Fiat Daily heard this conversation, he'd be so mad. They actually spend your money on other things, try and make more money, and they call this dangerous game fractional reserve lending. And many of them are so annoyed and so hopelessly dependent on the system that they will fight to protect it. Are you learning about Bitcoin? Or are you looking at the woman in the red dress? Look again. Freeze it. This is a government banker, and the gun to your head is fractional reserve lending. Whoa. So, in an eventuality the banks are not scared enough of, what would happen if enough people went to withdraw their funds at the same time and the banks don't actually have enough cash to settle it in the first place? Liquidity crisis. Banks would be forced to sell whatever assets they were holding to get the cash to cover their withdrawals or risk bankruptcy. Both scenarios, you potentially have a major recession on your hands. This is an oversimplification, of course, but let's continue. The Federal Reserve Department's job is to prevent things like this. This is why they're getting involved and injecting hundreds of billions of dollars this week, aka liquidity, into this relatively niche bank-to-bank lending market. How much longer they're going to have to keep this up for, though? It's been a week already. Jerome Powell, head of the Federal Reserve, had this to say earlier this week. Powell says the Fed may have to resume the organic growth of its balance sheet sooner than expected to help ease the money markets. So another solution the Fed can adopt in attempting to solve this liquidity problem is quantitative easing to help ease the money markets, as they so eloquently put it. This is a really scary thing, but great for gold. Bitcoin. Hopefully Bitcoin too. Quantitative easing was last used significantly during the last recession, where the Fed bought up to a peak of $2.1 trillion of bank debt, mortgage-backed securities, and treasury notes. This is inflation. This is going directly into the economy, directly devaluing the dollar. And in case you're wondering why I'm hung up on talking about US for the most part, even though I'm from the UK, it's the fact that many countries will follow suit. The UK did the exact same thing at the exact same time. Europe, Switzerland, Japan, etc., etc. Jerome, this good old fellow, is basically admitting they might need to start doing this again, which would no doubt be great for gold. And as we looked at in yesterday's video, gold and Bitcoin have strong correlation at present. So hey, bring it on. The reality, though, is that this is very scary for individuals who do not own something that cannot be inflated and devalued like this. Not so scary for crypto holders.
Everybody be cool, this is a robbery!
Any of you f***ing move, and I'll execute every last one of you!
But in a world where millennials are finding it almost impossible to own their own home, fine art ownership is a pipe dream. I think my wife was telling me yesterday that Jeffree Star owns $300,000 bags each as investments, because they're rare designs or something. But even £5 a week into gold might prove difficult, but Bitcoin, more than a potential solution, in my opinion. Whether Satoshi himself or not intended Bitcoin to be used for this purpose is a point of fierce debate. However, an interesting tidbit of information: the hash of the Genesis block has 2 more leading hex zeros than were required for an early block. The Coinbase parameter seen above in hex contains, along with normal data, the following text: a link to an article, which we can see over here, Chancellor on brink of second bailout for banks, an article directly talking about the dangers of fractional reserve lending. So